Wall Street goes on-chain, the race to tokenize the stock market, part 1 of 3. Wall Street goes on-chain. Something important is happening to the architecture of global finance. Apple shares can now be represented on a blockchain. So can Nvidia, Tesla, the S&P 500, Treasury securities, gold, and an expanding universe of other financial assets. Some trade 24 hours a day. Some can leave the exchange on which they were purchased and enter a private wallet. Some can be exchanged through decentralized markets. Some can become collateral. And alongside them, perpetual futures can provide leveraged exposure to many of the same assets without requiring ownership of the underlying security at all. At first glance, the story appears straightforward. Wall Street is putting stocks on blockchain. But that description misses the larger transformation. The important development is not that somebody has created another way to trade Apple. It is that the financial asset is beginning to separate from the distribution architecture through which investors have historically been required to access it. A conventional stock exists inside an enormous institutional structure. Brokers, exchanges, custodians, clearinghouses, banks, settlement systems, national regulations, and defined market hours. Tokenization does not make those institutions disappear, but it potentially creates another distribution layer above them. That leads to the central proposition: stablecoins made the dollar portable. Tokenization is attempting to make the capital market portable. Why do we care? Before getting lost in the technology, the obvious question is, why does any of this matter? The answer begins outside crypto. It begins with purchasing power. In an economic environment characterized by persistent monetary debasement, inflation, and increasingly K-shaped wealth outcomes, holding cash carries an opportunity cost. Cash provides liquidity, but over sufficiently long periods, its purchasing power can deteriorate. A store of value attempts to solve that problem. Gold, Bitcoin, scarce commodities, and other assets can function, to varying degrees and under different circumstances, as defenses against monetary dilution. But productive assets introduce another dimension. An equity is not simply a scarce object. It represents an economic claim on an operating enterprise. A successful company owns assets, employs people, produces goods or services, generates revenues, earns profits, reinvests capital, and potentially distributes cash to shareholders. That makes the distinction important. A hard asset can potentially preserve wealth. A productive asset can potentially preserve and compound wealth. Equities should therefore not simply be described as hard assets. They are claims on productive capital, and that characteristic makes access to them particularly valuable. For somebody already living inside a developed financial system, this may seem unremarkable. A resident of New York with a bank account and brokerage account can already move dollars into treasury bills, an S&P 500 ETF, Apple shares, gold, or dozens of other assets within minutes. But that experience is not universal. Billions of people live under currencies that are structurally weaker than the dollar. Others face capital controls, underdeveloped brokerage systems, high transaction costs, poor access to foreign securities, or financial institutions that simply do not offer the same investment universe. For those users, tokenization potentially addresses a different problem. Not convenience. Access. From weak currency to productive capital, stablecoins demonstrated the first stage of this process. They did not invent the dollar. They changed its distribution. A person no longer necessarily needs physical U.S. currency or direct access to the American banking system to hold a dollar-denominated digital asset. That created an important pathway: weak local currency to tokenized dollar. The next development was predictable: tokenized dollar to tokenized treasury. Now the user could potentially move beyond holding the monetary unit and begin earning dollar-denominated yield. Tokenized equities extend the progression again: weak currency to stablecoin to treasury yield to productive assets. This matters because capital preservation and capital accumulation are not the same objective. A stablecoin can provide relative protection from a rapidly depreciating domestic currency. A treasury instrument can add yield, but neither necessarily provides participation in the long-term growth of productive enterprise. Equities do. This is where the emerging market case for tokenization becomes more interesting. The strongest argument is not that somebody facing severe currency instability should immediately become a stock picker. It is that people outside developed financial systems may increasingly gain access to the same hierarchy of assets that wealthy investors in developed economies already take for granted: cash reserves, government bonds, equities, commodities, stores of value, eventually perhaps credit, real estate, and private market exposure. The progression is therefore not simply from bad money to better money. It is from monetary protection to capital ownership. Stablecoins showed the path. This makes stablecoins an important precedent for understanding what tokenized securities might become. The dollar already possessed enormous global demand before stablecoins existed. What blockchain changed was its portability. A dollar-denominated token could move across a digital network continuously. It could sit in a wallet. It could interact with smart contracts. It could cross borders without requiring the traditional correspondent banking architecture for every individual transfer. The same conceptual transformation is now being attempted across the rest of the balance sheet. A tokenized treasury makes government debt portable. A tokenized equity makes an economic claim on productive enterprise portable. A tokenized gold product makes commodity exposure portable. Tokenized credit could make fixed income claims portable. Private market structures could eventually make previously gated economic exposures more widely distributable. Put those developments together, and the destination becomes much larger than tokenized stocks. The wallet begins to resemble a balance sheet. Inside it might eventually sit dollars, treasury bills, Bitcoin, gold, Apple, an S&P 500 fund, corporate credit, commodities, and perhaps private company exposure. The importance of tokenization is therefore not necessarily the creation of new assets. Most of these assets already exist. The innovation is making existing assets increasingly digitally portable, interoperable, and globally distributable. That is why the comparison with stablecoins matters. Stablecoins made the dollar portable. Tokenization is attempting to make the capital market portable. And by 2026, that attempt has moved far enough beyond theory that a genuine competitive race has begun over who will build the infrastructure through which that portable capital market operates. Part 2. The 2026 Tokenization Race: Ownership, Exposure, and the Battle for the Stack. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Wall Street goes on-chain: The Race to Tokenize the Stock Market. Part 2 of 3, the 2026 Tokenization Race. By 2026, tokenized equities are no longer an isolated experiment. A competitive stack is emerging, and different companies are attacking different parts of it. Kraken and XStocks have built one of the broadest interoperable networks. XStocks now reports more than 700 tokenized stocks and ETFs, more than $35 billion in transaction volume, and support across multiple blockchains. The underlying structure is straightforward. Each XStock is backed one-to-one by the corresponding security held in regulated custody. Kraken then adds another layer. Eligible non-US traders can access perpetual futures based on XStock's benchmarks 24 hours a day, 7 days a week, with leverage reaching 20 times on selected products. Binance has attacked the market from another direction. Its B stocks are also backed one-to-one by underlying US shares, but exist as BEP20 tokens on BNB Smart Chain. Eligible users can trade them continuously, withdraw them into compatible wallets, and potentially deploy them through supported DeFi applications. Robinhood brings something different again: a gigantic conventional retail brokerage franchise attempting to bridge its users toward tokenized markets. Ondo approaches the problem from the institutional asset tokenization side. Hyperliquid and HIP3 attack an entirely different layer: derivatives and synthetic exposure. And Coinbase demonstrates how important the distinction between extended hours brokerage and genuine tokenization has become. A stock trading 24 hours a day on a centralized platform is not necessarily a tokenized stock. The decisive question is whether the financial instrument itself exists on-chain and can move beyond the originating venue. There may therefore never be a single winner. There could be one leader in assets under management, another in spot volume, another in derivatives turnover, another in distribution, and another in the number of tokenized securities available. The race is not merely for market share. It is a race to determine which layer of the new capital market stack becomes most valuable. Ownership versus exposure. That distinction forces us to answer a deceptively simple question. What exactly do I own when my wallet says Apple? There are at least 4 possible answers. At the first level sits the conventional share. The investor owns a security through the traditional regulated financial system and receives the legal rights associated with that security. At the second level sits the asset-backed token. An X stock, for example, is backed one-to-one by an underlying equity held in regulated custody. But Kraken explicitly notes that X stocks do not provide the same shareholder rights as owning the conventional security directly. Economic benefits, such as dividends, can be reflected through the token structure, but voting rights are not equivalent. At the third level sits the wrapper. A fund, certificate, or other intermediary structure may provide economic exposure to an asset without giving the holder direct ownership of that asset. At the fourth level sits the synthetic derivative. A perpetual future does not need to place an Apple share inside the trader's wallet at all. It simply creates a contract whose economic value tracks Apple's price. These distinctions matter because ownership and exposure are not synonymous, and they create 2 potentially enormous markets. The first is the ownership market. The customer says, I want to hold productive assets. The second is the exposure market. The customer says, I want the price action. For the first customer, backing, custody, redemption, and legal structure matter enormously. For the second, liquidity, leverage, execution speed, shorting, and capital efficiency may matter more. This is why tokenized spot volume and equity perpetual volume must remain analytically separate. $1 billion of turnover in a perpetual market does not represent $1 billion of equity changing ownership. Hyperliquid could eventually generate extraordinary turnover in equity-related contracts without custody of an equivalent quantity of underlying shares. Conversely, a tokenized equity network could hold enormous underlying assets while generating comparatively modest trading turnover. There may therefore be several different kings: king of assets, king of spot volume, king of derivatives, king of distribution, king of liquidity. The leaderboard depends entirely on what is being measured. Blockchain collapses space and time, but not law. The technological attraction of the system is easiest to understand through 2 dimensions: space and time. Traditional financial markets are geographically fragmented. Where someone lives can determine which broker they can use, which securities they can purchase, which currency they can fund with, and which regulatory regime governs the transaction. Blockchain dramatically reduces the technological significance of that geography. 2 wallets can interact across 5 meters or 5,000 kilometers using essentially the same network. But this is where the maximalist version of the tokenization thesis breaks down. A permissionless blockchain does not automatically create a permissionless security. There are several layers. The blockchain itself may be open. The token contract may contain controls. The issuer remains a legal entity. The custodian remains subject to regulation, and the underlying Apple share remains embedded in securities law and corporate law. Xstocks illustrates the tension perfectly. The tokens can be withdrawn into self-custody and traded on-chain, but the official product remains unavailable in several jurisdictions, including the United States, United Kingdom, Canada, and Australia. So the more defensible formulation is not, blockchain abolishes financial borders. It is, blockchain collapses the technological cost of financial geography. Regulation can put the borders back in. Time undergoes a similar transformation. Traditional exchanges have opening and closing hours because their market infrastructure was built around institutions operating within defined sessions. Blockchain has no natural closing bell. Once a financial instrument exists on-chain, there is no fundamental technological requirement that transfers stop on Friday evening. The progression therefore becomes traditional session, extended hours, 24/5, 24/7. Kraken itself demonstrates all 3 architectures simultaneously. Much of its centralized Xstocks trading remains 24/5. Selected Xstocks have expanded availability, and withdrawn tokens can trade continuously on-chain. But another important distinction follows. 24/7 tradability does not mean 24/7 liquidity. When NASDAQ is closed, the underlying Apple market is not continuously providing the same depth of price discovery. Market makers may therefore demand wider spreads. Order books may become thinner. Slippage may increase. Prices may temporarily diverge. Weekend markets may become substantially more volatile. That does not invalidate continuous trading. It simply means that the mature version of a 24/7 capital market may operate much like other global markets. The market is always available, but the price of immediacy changes with liquidity. And that brings us to the most important correction to the original thesis. The technological infrastructure can become continuous and global without the legal infrastructure becoming either permissionless or borderless. Wall Street can go on-chain without Wall Street disappearing. Part 3. Wall Street doesn't disappear. The portable capital market. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Wall Street goes on-chain, the race to tokenize the stock market. Part 3 of 3. Wall Street doesn't disappear. This is where the strongest version of the tokenization thesis needs qualification. If Apple remains an American corporation, its shares remain embedded in American corporate and securities law. The company still needs mechanisms for raising capital. Shareholders still require legally enforceable ownership rights. Corporate actions still need administration. Custodians still need to hold underlying securities. Regulators still police issuance, disclosure, sanctions, and market conduct. And the deepest pools of liquidity and primary price discovery may continue to reside on regulated exchanges. Tokenization does not magically remove those functions, but it may change where the financial asset travels after those functions have been performed. That requires separating two things that are often bundled together. The first is the primary capital market. This is where companies raise capital, securities are legally issued, corporate governance is established and regulated, ownership originates. The second is the secondary distribution architecture. This is where investors acquire exposure, securities change hands, assets become collateral, lending occurs, and derivatives are created. Blockchain does not need to replace the first layer to transform the second. NYSE or NASDAQ could remain where Apple raises capital and where its primary shares achieve their deepest price discovery. The blockchain could increasingly become one of the places where economic exposure to Apple travels afterward. That produces a much more defensible proposition than saying blockchain replaces the stock exchange. Wall Street may continue manufacturing and legally anchoring the assets while losing its monopoly over their distribution. The portable capital market. Follow that architecture to its logical conclusion. A wallet no longer contains merely cryptocurrency. It contains a balance sheet. There are dollars for liquidity, treasury securities for yield, Bitcoin or gold for scarcity and monetary protection, equities for participation in productive enterprise, corporate credit for income, commodities for diversification, perhaps eventually real estate exposure, perhaps private company exposure. Those assets need not simply sit there. Some can become collateral, some can generate yield, some can be lent, others can be hedged. Some can potentially be exchanged against one another continuously. The result begins to resemble something historically available mainly through sophisticated financial institutions, private banks, and brokerage platforms. Except the organizing object is no longer necessarily the institution, it is the wallet. That creates a subtle inversion. The traditional question is, which institution gives me access to these assets? The emerging question becomes, which assets do I already control, and which venue currently gives me the best execution, liquidity, yield, or financing against them? That distinction is profound. In the legacy model, the institution owns the customer relationship and grants the customer access to financial assets. In the emerging model, the customer may increasingly control the financial assets directly, while institutions and protocols compete for the customer's liquidity. That does not eliminate intermediaries. It changes their bargaining position. The emerging market test. This is also where the emerging market thesis needs to remain disciplined. The first killer application is unlikely to be stock speculation. Someone living under severe monetary instability usually has a more immediate problem. They need to preserve purchasing power. That makes the initial progression relatively straightforward. Weak currency, stablecoin, tokenized treasury yield. Those instruments may solve a larger and more urgent problem than tokenized equities, but preservation and accumulation are different objectives. Once somebody has gained access to stronger money and relatively safe yield, there is no obvious reason why their financial development should permanently stop there. A middle-class saver in Lagos, Buenos Aires, Accra, or Jakarta ultimately faces many of the same long-term questions as a saver in London or New York. How much should remain liquid? How much should earn fixed income yield? How much should participate in productive economic growth? How much should sit in scarce assets? How should risk be diversified? Developed financial systems already answer those questions through diversified portfolios. Tokenization potentially makes parts of that portfolio architecture more globally accessible. So the stronger claim is not, everybody needs tokenized stocks. It is, tokenization potentially expands the menu of capital available to people whose financial systems historically restricted the menu. Stablecoins address monetary access. Tokenized treasuries address yield access. Tokenized equities address productive capital access. They are complementary stages rather than competing explanations. The end state is not necessarily permissionless. This also forces one final correction. The destination should not automatically be described as a completely permissionless financial system. Bitcoin can approach that description because there is no underlying issuer, custodian, or corporation whose legal existence anchors the asset. A tokenized Apple share is different. Somewhere underneath the token sits Apple. Somewhere sits a legally recognized security. Somewhere sits custody. Somewhere sits an issuer or intermediary structure connecting the blockchain representation to the underlying asset. That connection is precisely what gives a backed token credibility, and it is simultaneously what prevents the asset from becoming completely independent of the traditional legal system. This is not necessarily a weakness. It may simply describe the hybrid architecture that ultimately wins. Permissionless settlement technology underneath, regulated financial claims above it. Different assets can occupy different positions along that spectrum. The crucial innovation is therefore not necessarily censorship resistance. It is portability, the more defensible thesis. The original temptation is to frame tokenization as a battle between two worlds. Wall Street on one side, blockchain on the other. One eventually replaces the other. The evidence points towards something more interesting. Wall Street may remain essential to capital formation, corporate governance, custody, legal enforcement, and primary price discovery. Blockchain may become increasingly important to distribution, settlement, collateralization, secondary trading, and global financial access. The two systems can therefore converge. The corporation remains legally anchored. The security remains regulated. The underlying asset remains custodied. But its economic representation becomes increasingly portable. That is why the transformation can be significant even if NYSE and NASDAQ remain exactly where they are. The revolution does not require Wall Street to disappear. It requires the financial products created by Wall Street to become capable of traveling beyond Wall Street's traditional distribution architecture. And that changes the central question. It is no longer, can blockchain replace the stock market? It is. Once financial assets become genuinely portable, must investors continue accessing and using them through the same institutions that historically controlled their distribution? Kraken, Binance, Robinhood, Ondo, Hyperliquid, Dinari, Coinbase, and the companies that follow them are beginning to answer that question in different ways. Some are tokenizing ownership, some are distributing the tokens, some are building liquidity, some are creating derivatives, some are constructing the regulatory bridge, some are simply making exposure trade 24 hours a day. Together, however, they point in the same direction. Financial assets are becoming increasingly internet native. The legal borders remain, the regulatory perimeter remains, the underlying corporations remain, and the traditional exchanges remain. But the distribution surface is beginning to change. That leaves us with a more modest thesis than the maximalist blockchain argument, but a potentially more consequential one. Wall Street may continue to manufacture and legally anchor the assets. What is now being contested is whether Wall Street must continue to control how the rest of the world accesses, trades, and uses them. Stablecoins provided the first large-scale demonstration of what happens when an existing financial instrument becomes digitally portable. They did not replace the dollar. They changed who could access it, where it could travel, and what could be built around it. Tokenization is now attempting to perform the same operation on the rest of the capital market. Stablecoins made the dollar portable. Tokenization is attempting to make the capital market portable